Hi everybody, so we're going to go over the markets, we're going to take a look at certain things, but before I do that, I want to talk about something that's really important, and that's trading related. That's one of the key things that the white collar trader knows about. First, I want to talk about trend. Now, this is what you're taught, trend up and down, up and down, and up and down, right? But let's say you're the composite man or the composite operator, the CM, smart money, and your prices, for example, is here, and you want it to go whatever, and you want it to go here, right? So you want it to go up. A lot of times, in order to get the price to go up, what do you need to do? And this is really important to understand, because this is how markets move. They require, or there's anyway, this is what it is. It's basically short covering. All right, the same opposite thing on the other side, but this is the idea. So you need short covering. Short covering helps move the markets higher, because as soon as you go up, the stops get hit and they trigger buy, 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 buy. So how does short covering occur? You have to make lower lows. You have to make lower lows. All right. So this is just keep in your mind that this is very, very important in order to make a new high. In order to make a higher high, all right, so short covering will help a lot. All right, so this is why markets don't really make higher lows like this. Yes, sometimes in states of momentum and all of that, but a lot of times what you have, let me use white. No. I'll use let me use green. You have use green again. You have lower lows. This lower low, when prices get above, right? When prices get above these areas, the stops are hit and price makes a higher high. Okay, so the thing to really understand here is how beneficial this is one, lower lows will help accumulation, because one side sells, the other buys, right? Two, it will shake out. And three, most important, will cause short covering. Now, the shakeout is important because as you want to go up, you don't want buyers who are already in selling on the way up, because if they have a good amount of position, it will make less of ease of movement, meaning the ease of movement will not be as great as it is after a shakeout when the longs are out. If the longs are in As price goes up, they will sell and take profits. They might take a profit here, resistance here. They take profits. So that taking profit will stunt the ability for the market to make higher highs. So this is why shakeouts or springs, which are minor shakeouts, are good, because that will allow ease of movement to the upside. The second thing with these lower lows is that they're the best way to accumulate. They're the best way to accumulate. They're a quick way to accumulate versus an extended time or extended range. Now you can just hit the stops and accumulate the stops. One side sells, the other buys right here. And third is short covering. Why? Because the shorts are here. Then as soon as these highs are taken, the buy stops get triggered and it creates the rally. It creates the pressure for the higher high rally. Now there's so many examples of this, but I will prove it to you. Just watch this model, okay? The lower low leads to the higher high. What did I do? The lower low leads to the higher high, meaning the spring or whatever low low leads to the higher high. You see this over and over and over again in the market. Let's just pick the ES. I'll just take a look at any trend. Okay, this is any uptrend. So this here, right? Okay, we'll just analyze this trend, and I'll analyze another trend if you like, to show you how lower lows, given those three reasons, create the higher high. What is this? That is your lower low creating your higher high. What is this? That is your lower low creating your higher high. All right, so this lower low created that higher high. This lower low, I don't know what happened, but what happened here? All right, so lower low creates the higher high. Lower low create the higher high. Lower low again. That's the lower low creates the higher high. That's the lower low creates the higher high. That's the lower low creates this high or this high, whichever high you want to use. That's the lower low creates the higher high. Notice how virtually every time there's a higher high, not every time, but the majority of times, there's some type of lower low. Lower low, higher high, lower low, higher high, right? Then when it reestablishes, lower low, higher high, right? So what's the point? The point is, in a trend, In a trend, it's the lower lows. The lower lows that you should be on guard. They are buying opportunities. They're buying opportunities to get the next rally. All right? This is the point that I'm trying to make. They're buying opportunities to get the next rally in the trend. How should I say this? Lower lows are buying opportunities to get the next rally in an uptrend. Again, lower lows are buying opportunities to get the next rally in an uptrend. Now, maybe you want more examples or something. I'll give you more examples. I mean, this happens over and over again. Just look, I have this on a rally, right? So there's no BS, right? So over here, they didn't make lower lows, so, you know, but here, it tapped right here. Lower low. Actually, this one and this one, lower low. What happened? Rally. Rally came from a clear lower low. So we'll just keep examining. Where's the next rally? Right there. Where's the lower low? Right there. You know how obvious this is? It literally is in the color red. It literally is. It goes from white to red. So there's no, interpretation here. It goes from white to red on the lower low, and then bang. It goes from white to red, lower low, and then bang. And the same thing on the upside. It goes from red to white, right? And then bang, rally right there. You just look for the rallies. It's also lower low. The lower low. This was the higher high. What did it create? Rally. Rally. And I'm not interpreting anything. These are mechanical signals. These are indicator based. Indicators are telling. I'm not doing nothing. It's just indicator. Boom. Rally indicator. The higher high is a white. If it goes red to white and then boom down. Other one, red to white and then bang within a downtrend. Of course, you have to. It's within the trend. Or white to red. Makes lower low and bang. So this is what I'm explaining here is how trends really work. See, trends, they generally they don't really do this. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low is not really the case because the consolidations typically have ABC patterns or something like that. I'll give even example on a daily. It looks like it's higher lows, right? But it's not. Look over here. This, okay, this one you could say made a higher low and then went up, but this one is actually a lower low. This is a low. Market makes a lower low, rejects, test, and go. You see? I'm not sure about this one yet. Let me see. This low, 37.75. This low. Oh shit, this is actually a lower low too. It's a low low. It's a lower low. It's very slight, but it did cause a pop. Now this, I'm looking for it to make a lower low. If it makes a lower low, it's on watch. So hopefully I've proven to you the importance of lower lows in uptrends, because lower lows typically occur before the higher high rally. Lower lows before the higher high, lower lows before the higher high. Again and again and again, lower lows before the higher high rally. Showing you, this is game, that lower lows before the higher high rally, and vice versa in downtrends. So this is, and for the reasons I explained, primarily because lower lows will allow for quick accumulation because of the stop run, and lower lows, when they go back up, will create the buying pressure to create a higher high rally. So you need to go lower in order to go higher. You need to go lower in order to buy cheap, and in order to run stops to create the buying pressure to take the market higher and rally. All right, so very important. All right, now we're done with the lesson part. So pay attention to lower lows, in uptrends, and higher highs in downtrends. Look for the opportunity. Anyway, let's take a look at certain markets that are at key levels. All right, so what is this? I usually don't trade this market, but whatever. Nah, forget this. All right. Yeah, I really don't have anything else, but I mean, this is the Russell. It rallied. It made a lower low right here, right? It's springing, making the lower low, and we'll see if this retest holds to make a next higher high or not. Right? And you can see like all the buying that came in. See this? Right? But that goes down. Buying. Biggest bar in 100 bars, take the retest, make money on the way up. Done. All right, I'm done. Have a good weekend, and really pay attention to the wave chart, which will simplify a lot of this, because bars are just, bar chart is great, but or candle chart, but if you can put like a wave chart on it, you'll see what I'm talking about. It shows trend. It shows the lower low setting up the higher high. It shows the tests in the region and all that. So, and it's what Wyckoff used as his tape reading tool. The tape reading tool that Wyckoff used was actually a wave chart. And what he was first and foremost most interested in was distance, then duration. Meaning distance is the size of the wave. Duration is how long the wave lasted. So distance and duration, and then he added other things like volume and activity. But basically what supply and demand is which side has the greater power. I think it was a pulling power or pushing power. I think it was pulling power. And that's the side you want to be aligned with. And that is nothing more than trading with a trend. Anyway, thank you. Have a good weekend. Bye.